How you pay yourself from your LLC in 2025 will be very important. For one, the cap for self-employment tax has been set to about $176,000, which means you will pay a 15.3% additional tax on all of your business income up to this amount if you do not pay yourself correctly from your LLC. Not to mention the fact that there are several ways to actually pay yourself from your LLC, like owner distributions, payroll, dividends, and so on. So right now, a lot of people want to know, what is the best way to pay themselves from their LLC? What method should you use? How much should you pay yourself? And more importantly, how much should you actually leave in your business account to continue to fund operations, pay taxes, and so on? If that's you, don't worry. I am going to explain and simplify all of this for you as a licensed CPA that tax plans every single day for business owners at mycpacoach.com. So stick around until the end for everything that you need to know. All right, so let's start with the basics. Ideally, before you start paying yourself from your LLC, you have to have two very important things. Number one, you should have an employer identification number for your LLC. Now, this is like a social security number for your business. And if you do not have this, you can easily apply for one of these for free on the IRS's website, which I'll also link for you in the description below. And number two, you should have a business bank account for your LLC specifically, which should operate completely separately from your personal bank account for a number of reasons. First off, if you commingle personal funds with your business funds, you can lose your limited liability protection, which is the whole point of setting up a limited liability company in the first place, right? To protect your personal assets in the event of a business liability. And secondly, if the IRS sees that you are commingling personal and business funds, they may start to question the legitimacy of tax deductions that you are claiming, and they can even disallow them.
That's a no for me.
So before you do anything, make sure you have these two things set up before you pay yourself. Now let's talk about the actual act of paying yourself from your LLC. So the method you use to pay yourself will depend on your LLC's tax classification with the IRS, and there are about 3 different classifications that you need to know and can choose from. Number 1, a disregarded entity. Now, this is the default tax classification for most LLCs. So if you have never sent any paperwork to the IRS to elect how you want your LLC to be taxed, then it is likely being taxed as a disregarded entity, which is over half of LLCs. Now, a disregarded entity is exactly what the name implies. The IRS is basically saying that for tax purposes only, they will disregard your entity and therefore tax 100% of the entity's income to the owners of the LLC. Now, this is very important when we talk about paying yourself from your LLC, because this now means that you will pay tax on 100% of your LLC profits, even if you do not pay yourself at all from your LLC. A lot of people I talk to think that they only pay tax on payments they take from their LLC, but no, you can leave all of your profits in your business and still be left with a big personal tax bill. Plus, on top of this, disregarded entities are subject to the 15.3% self-employment tax, which does not apply to other entity classifications, which we will talk about shortly here. But since most LLCs operate as disregarded entities, let's first talk about how to pay yourself from an entity classified like this. And it's actually very simple. All you would have to do is take an owner's draw, which is more formally referred to as an owner's distribution. Now, to pay yourself with this method, all you would really have to do is transfer funds from your business bank account over to your personal bank account. And you can do this with a bank transfer, wire, check, or you can go directly to your bank and withdraw cash from your account. It's really up to you. But when you do this, you would categorize this transaction in your books as an owner's distribution or owner's draw. Now, whenever you pay yourself from your business, it is always a good idea to put some money aside for taxes. because remember, no taxes are being withheld from your paychecks like they ordinarily would if you were a W-2 employee. In general, it is a best practice to put aside anywhere from 25 to 30% of your gross income aside for taxes, which may be higher or lower based on your income and your overall tax rate. Or if you're working with a good CPA, they should be able to estimate your income tax so that it does not surprise you at tax time. And even better, if they can help you build a plan to reduce that tax before it comes like we do at our firm. Anyway, outside of putting money aside for taxes, that's not the only thing we need to address here. You should also leave enough income in the business to fund your business operations. As you probably know, cash is fuel for any business. And if you take too much cash out of it, you can jeopardize the livelihood of your business. Now, generally, you will want to leave enough cash to cover at least 3 months of operating expenses in your business, and in some cases, even more. So that's how you would pay yourself when your LLC is classified as a disregarded entity. But this classification is not always the best one to choose, especially if you want to pay the least amount of money in taxes, specifically self-employment tax, which I've already told you is a 15.3% additional tax assessed on the profits of disregarded entities on top of your federal income tax and on top of your state income tax. So for example, a business owner with $100,000 in business profits would pay $15,000 in self-employment tax alone, whereas other LLC classifications are not subject to this tax at all, at least directly anyway. So let's go ahead and talk about some better classifications and how to pay yourself from them, starting with LLCs that are taxed as an S corporation. Now, the number one reason LLC owners elect S corporation status is to avoid the 15.3% self-employment tax. S corporations are not subject to self-employment tax at all, but there are additional requirements as it relates to paying yourself from an LLC that is taxed as an S corporation. And the most significant requirement is the reasonable compensation rule, which requires shareholder employees of S corporations to pay themselves W-2 wages for the work they do in their business. And as you probably know, if you've received a W-2 wage, you are subject to Social Security and Medicare taxes from those checks, which is basically how the IRS makes up for some of the self-employment tax it is losing from S corporations. However, this can still create significant tax savings in situations where you take less W-2 wages than your business profits, which is usually the case for 90% of S corporations or more. So for example, let's say you have $100,000 in profits and you take a $40,000 W-2 from your S Corp. Well, instead of paying the 15% tax on $100,000, you would only pay it on your $40,000 W-2 in the form of Social Security and Medicare taxes. So instead of paying $15,000 in self-employment tax, you would only pay about $6,000 instead, literally saving you over $9,000 in taxes. So that's why people elect to be taxed as an S corporation. Now let's talk about how to actually pay yourself from it when you are taxed that way. And a lot of people get this confused, so let's break this down. So I like to explain it to my clients this way. When you are an S corporation, you get paid a W-2 for the work you do in the S Corp. And you get paid distributions for the ownership you have in the S Corp. So you are both an employee of the business receiving a W-2 wage and the owner of the business as well, receiving distributions. Now, to set yourself up as a W-2 employee from your company, you would need to use a payroll company. And if you need one, I will link one of my favorite companies to use in the description below, as well as a discount for you. Now, as a business owner, remember, you will still be able to pay yourself owner distributions, similar to how you would get paid from a disregarded entity like we discussed earlier, which a lot of my S Corp clients forget about. A lot of people think that the only way to pay themselves from an S Corp is through a W-2. Whereas in reality, that is just the first way you're supposed to pay yourself. And once you satisfy that requirement, you can still transfer business funds from your business account over to your personal account as an owner's distribution. So that is how you would pay yourself when your LLC is taxed as an S corporation. Now, while the S corporation does save you money in self-employment tax, it still taxes 100% of the business profits to the owners of the company, which can pose an issue for people who want to leave money in their business without paying taxes on those funds. And for those people, they may be better suited by having their LLC taxed as a C corporation. So let's break this down and how you would pay yourself from it in that situation. So first of all, C corporations are rising in popularity primarily due to the low tax rate that it has of 21% and may be even lower in the future. So an LLC owner in a 32% or 37% tax bracket would immediately save money on taxes by having their LLC taxed as a C corporation. That's if they don't take any distributions from the corporation though. When you take distributions from a C corporation, which actually would be referred to here as a dividend, when you have a C corp, you must pay tax on those dividends, effectively resulting in double taxation. However, the second tax can largely be avoided in situations where shareholders are not taking dividends or in situations where they don't take large amounts of it. For example, let's say your LLC earned $100,000 and you are already in the 37% tax bracket. Well, in that case, they would pay $37,000 in individual taxes as a disregarded entity or S corporation. But let's say the LLC is taxed as a C corporation. Well, in that case, the entity would only pay $21,000 in tax at the entity level, which could be the end of this example, by the way, but let's say the owner needs $30,000, so they take a $30,000 dividend. In that case, the $30,000 dividend would be taxed as a qualified dividend, which is taxed a little bit lower, ranging from 15 to 20%. But even if it was 20%, that would just add $6,000 in additional taxes for the shareholder, meaning that as a C corporation, they would pay a total of $27,000 in taxes, as opposed to $37,000 when their LLC is taxed as a disregarded entity or S corporation. So that's typically the use case for C corporations in general. Now let's talk about how to pay yourself when you operate your LLC as a C corp. So number one, officers of C corps must take a W-2 salary for the work performed in it. And number two, C corporations must issue dividends to shareholders in a reasonable manner. And there are some rules about that from the IRS. Now, a bonus tip here is that C corporations can also make loans to shareholders without those loans being taxable to them, but those loans must follow very strict guidelines, which I will also save for another video. But as you can see here, the method in which you pay yourself from your LLC will first depend on how it's classified, and then how it's classified will directly affect your personal finances and taxes. So it is a very nuanced topic that you will want to speak to your CPA about. But generally speaking, disregarded entities work well when business profits are less than $50,000, and S corporations work great until your tax rate crosses about 30%. And at that point, a C corporation may or can be beneficial if you have a justifiable reason to reinvest funds back into your business. For more tax saving tips just like this, make sure you subscribe to our channel. And if you want a plan that is guaranteed to reduce your taxes, then just head over to mycpacoach.com to apply to work with one of my CPAs today.